The escalating Middle East conflict, combined with a shocking deterioration in U.S. jobs data, has delivered an extreme combination to global markets: oil above $100 and negative payroll growth. The Fed now faces its toughest policy dilemma since the pandemic. On one side, the risk of runaway inflation; on the other, a rapidly cooling jobs market trapped in the middle. Friday's February non-farm payrolls report came in well below expectations, with an unexpected loss of 92,000 jobs and the unemployment rate climbing to 4.4%, completely shattering market optimism that the labor market was stabilizing. Just weeks ago, January's report was seen as a sign of recovery. February's data declares that jobs are back in a downturn, sharply escalating fears of an economic slowdown. To make matters worse, the Middle East conflict has brought shipping through the Strait of Hormuz to a near standstill, delivering an unprecedented energy supply shock. In Asian trading on Monday, both WTI and Brent crude blasted through $100 a barrel, with intraday gains topping 20%, officially ushering in the triple-digit oil era. Goldman and others had warned that a prolonged blockade could send prices to record highs. The energy price explosion has lit the fuse on inflation. U.S. inflation was already running above the 2% target for 5 straight years. Now it faces a fresh wave of broad-based upward pressure. In a stark assessment, new Fed whisperer Nick Timiraos wrote that the Fed's worst-case scenario has arrived, a forced choice between fighting inflation and protecting jobs. Chicago Fed President Goolsbee put it bluntly: rising inflation alongside climbing unemployment is a nightmare for any central bank. Fed Governor Waller also warned that a sharp spike in gasoline prices is imminent, directly hammering household consumption and inflation expectations. The situation leaves the Fed completely boxed in. Cut rates to save jobs, and they risk fueling the oil-driven inflation pressure, a repeat of the 2021 transitory mistake. Hold rates high to fight inflation, and they may accelerate a slide into recession. Multiple Fed officials have voiced alarm. Minneapolis Fed President Kashkari stated bluntly that the current situation mirrors the period after the Russia-Ukraine conflict, and the Fed cannot repeat the transitory inflation error. Goolsbee warned that once inflation expectations become unanchored, the cost of re-anchoring them will be immense. The bond market has already delivered its verdict. Despite Friday's sharply weaker payrolls, the 10-year Treasury yield barely budged lower, signaling that markets believe the Fed cannot ease even with a softening jobs market. Expectations for rate cuts continue to fade. The probability of a June cut has collapsed from near certainty at the start of the year. Internally, divisions at the Fed are widening. One camp argues that persistently rising unemployment will force a mid-year rate cut. The other insists that the decline in inflation had already stalled, and the conflict is merely amplifying existing pressures. Easing now would be a mistake. Timiraos judges that the Fed will stay in wait-and-see mode for now, not pivoting on one-month data, but the data over the coming months will determine the path. More troubling, this shock has staying power. The Fed's inflation problem didn't start with the Strait of Hormuz blockade, and it won't end if the strait reopens tomorrow. Combined with tariffs, supply chain disruptions, and other supply-side shocks, the specter of high inflation plus low growth, stagflation, is looming. For the Fed, this is more than just a data shock. It's a full-scale test of its policy framework, credibility, and independence.